The idea of the US dollar's exorbitant privilege refers to the extraordinary advantages the United States has enjoyed for decades simply because its currency functions as the world's primary reserve and trading medium. This privileged position has allowed the US government to borrow at lower interest rates than most other countries, run persistent trade deficits without facing immediate currency collapse, and finance large public spending programs by issuing debt that global investors eagerly absorb. In practical terms, it has meant that the rest of the world has helped underwrite American consumption and government spending, creating a unique economic cushion that few nations could ever hope to possess. However, this privilege has never been guaranteed by law or nature. It has been sustained by confidence, confidence in US political stability, in the strength of its institutions, in the credibility of its central bank, and in the belief that American debt will always be honored without inflationary erosion. When that confidence weakens, even slightly, the foundation of the dollar's dominance begins to show cracks. Investors start asking new questions. Will rising debt levels eventually force higher inflation? Will political polarization prevent responsible fiscal decision making? Will the Federal Reserve face pressure to prioritize short term growth over long term stability? The growing scale of US government borrowing has intensified these concerns. National debt has expanded rapidly, and interest payments are consuming a larger share of federal revenue. This creates a feedback loop in which more borrowing is required simply to service existing obligations. While the dollar's reserve status has allowed the United States to manage this situation longer than most countries could, it has also encouraged a culture of fiscal complacency. When borrowing remains cheap and demand for Treasury seems endless, policymakers face less pressure to address structural imbalances, reform tax systems, or confront inefficient spending priorities. At the same time, global economic dynamics are shifting. Emerging economies are becoming more assertive. Regional trade agreements are reducing dependence on dollar based transactions, and some countries are actively promoting alternative settlement systems. These developments do not immediately dethrone the dollar, but they gradually chip away at its centrality. Each new bilateral trade deal that avoids the dollar, each central bank that diversifies its reserves, and each institutional investor that reduces exposure to US debt represents a small but meaningful step away from the old financial order. The challenge to the dollar's privilege is also tied to domestic inequality and social strain. When the government relies heavily on borrowing rather than progressive revenue systems, the long term burden often shifts onto ordinary citizens through inflation, reduced public services, or higher future taxes. This creates political tension and public dissatisfaction, further weakening the perception of stability that underpins currency dominance. In this sense, the erosion of the dollar's privileged status is not only a financial issue, but a social and political one rooted in how economic power and responsibility are distributed within the country. As these pressures accumulate, the once unquestioned assumption that the dollar will always remain the world's financial anchor becomes less secure, forcing investors, governments, and institutions to reconsider long held beliefs about safety, stability, and economic leadership. Pension funds occupy a unique and powerful position in the global financial system because they are designed around long term responsibility rather than short term speculation. Their primary mission is not to chase rapid profits, but to protect the retirement security of millions of workers who depend on steady, predictable returns over decades. For this reason, their investment decisions tend to be cautious, data driven, and deeply influenced by assessments of structural stability. When a major pension fund reduces its exposure to U.S. Treasuries, it is not acting on impulse or market rumors. It is responding to underlying shifts that it believes could affect the long term reliability of those assets. Unlike hedge funds or high frequency traders, pension funds operate with strict risk management frameworks. They analyze inflation trends, interest rate cycles, demographic changes, and government fiscal behavior. They also model worst case scenarios, including prolonged economic downturns or policy instability. When such institutions begin to adjust their portfolios away from assets traditionally labeled risk free, it signals that their internal models are detecting rising uncertainty. This is why pension fund movements often serve as early warning indicators rather than reactions to crisis moments. They reflect anticipation, not panic. One of the key concerns driving these decisions is the sustainability of government debt. As debt levels rise, the probability increases that governments will face difficult choices between raising taxes, cutting spending, or allowing inflation to erode the real value of their obligations. For long term investors, inflation is particularly dangerous because it quietly reduces the purchasing power of fixed income returns. A bond may pay interest reliably, but if inflation outpaces that return, the real value of the investment declines. Pension funds responsible for maintaining future purchasing power for retirees cannot ignore this risk. Another factor shaping pension fund behavior is political uncertainty. Frequent budget standoffs, threats of government shutdowns, and debates over debt ceilings create an environment in which fiscal planning becomes unpredictable. Even if default remains unlikely, the repeated appearance of institutional instability undermines confidence. For conservative investors, stability is as important as yield. When political processes appear fragile or increasingly polarized, the perceived safety of government backed assets begins to weaken. Additionally, global diversification strategies are becoming more attractive. Pension funds are expanding investments into infrastructure, green energy, emerging markets, and non dollar denominated assets to reduce dependence on a single financial system. This shift reflects not hostility toward the United States, but a recognition that concentration risk has grown. Relying too heavily on one currency or one government's debt exposes portfolios to systemic shocks that could ripple across markets. These changes illustrate that pension fund behavior should be interpreted as a structural signal rather than a temporary adjustment. It reflects a broader reassessment of what safe means in a world of rising debt, geopolitical tension, and economic transformation, and it reveals how the guardians of long term capital are quietly repositioning themselves in response to deeper financial realities. Political gridlock has become one of the most underestimated economic risks facing modern financial systems, particularly in countries whose currencies play a dominant global role. When governments are unable to pass budgets efficiently, agree on long term fiscal strategies, or resolve internal conflicts without public confrontation, they send a powerful signal to investors about institutional fragility. Markets may tolerate short term disagreements, but repeated cycles of shutdown threats, debt ceiling standoffs, and emergency funding measures create the impression that economic governance is reactive rather than strategic. For international investors, confidence is built not only on economic indicators, but also on the credibility of political institutions. Stable policy making allows businesses to plan, central banks to operate with clarity, and financial markets to function without constant disruption. When lawmakers prioritize partisan competition over long term national interest, uncertainty becomes embedded in the system. This uncertainty translates directly into risk premiums, higher borrowing costs, and a greater reluctance to commit capital for extended periods. The impact of gridlock is especially severe when it affects fiscal policy. Budget delays can halt infrastructure projects, disrupt government services, and create uncertainty around public sector employment. More importantly, they undermine trust in the government's ability to manage debt responsibly. Investors begin to question whether future obligations will be handled through disciplined policy or through emergency measures that rely on short term fixes. Over time, this erodes the perception that government bonds represent a stable foundation for global portfolios. Central banks are also affected by political dysfunction. While they are often designed to operate independently, their effectiveness depends on a supportive policy environment. When fiscal authorities fail to provide clear direction or engage in prolonged conflict, central banks are forced to compensate through monetary tools such as interest rate adjustments or asset purchases. This places additional pressure on monetary institutions and blurs the boundary between fiscal and monetary responsibility, increasing concerns about inflation, asset bubbles, and long term financial stability. Domestic consequences further amplify the problem. Political paralysis often results in delayed social programs, underfunded public services, and stalled economic reforms. These outcomes weaken consumer confidence and slow economic growth. As growth weakens, tax revenues decline, making it even harder to address debt and budget challenges. This creates a self reinforcing cycle in which political dysfunction contributes to economic strain, and economic strain intensifies political conflict. On the global stage, repeated displays of internal division reduce a country's ability to lead international economic initiatives. Trade negotiations, financial cooperation agreements, and crisis response efforts become more difficult when partners perceive instability. Allies and investors alike begin to hedge their exposure by diversifying trade relationships and financial holdings. Over time, this reduces the central role once played by dominant economic powers and accelerates the movement toward alternative financial arrangements. The longer gridlock persists, the more it reshapes expectations. What once would have been considered an exceptional crisis becomes normalized behavior. Markets adjust not by ignoring the risk, but by building it into pricing, portfolio strategies, and long term planning. This normalization of dysfunction quietly weakens economic credibility and gradually transforms political instability into a permanent structural factor in financial decision making. The slow rebalancing of global financial power reflects a fundamental shift in how countries and institutions perceive economic influence and security. For much of the modern era, the international system has revolved around a single dominant currency and the political authority behind it. This arrangement gave the issuing country extraordinary leverage over global trade, capital flows, and financial standards. However, as economic growth becomes more distributed across regions and as geopolitical competition intensifies, the incentive to rely on a single financial center has begun to weaken. Many nations are now actively pursuing strategies to reduce their dependence on the US dollar in international transactions. This includes settling bilateral trade agreements in local currencies, expanding regional payment systems, and increasing the share of non dollar assets in central bank reserves. These changes are not driven solely by ideology, but by practical risk management. Countries that depend heavily on dollar based systems are vulnerable to external policy decisions, interest rate shifts, and financial sanctions. Diversification provides a form of economic insurance, allowing governments to protect themselves from sudden shocks originating outside their borders. Technological innovation has further accelerated this shift. Digital payment platforms, cross border settlement networks, and financial infrastructure modernization have made it easier to conduct international transactions without routing everything through traditional dollar based channels. While these alternatives are not yet dominant, they are steadily improving in efficiency and scale. As adoption grows, they reduce the structural advantage once held by legacy financial systems and open the door to a more multipolar monetary environment. The rise of regional economic blocs also contributes to this transformation. Trade partnerships in Asia, Europe, Africa, and Latin America increasingly emphasize internal cooperation and shared financial mechanisms. By strengthening regional supply chains and investment networks, these blocs decrease reliance on external financial centers. Over time, this fosters greater monetary autonomy and shifts the balance of influence away from any single global authority. This rebalancing of power has political implications as well. Currency dominance has long been a tool of diplomatic leverage, shaping alliances and influencing international policy decisions. As alternative financial pathways expand, the effectiveness of economic pressure tactics diminishes. Countries gain greater freedom to pursue independent policies without facing immediate financial retaliation. This redistribution of influence reshapes global negotiations, altering the dynamics of trade, security, and development assistance. At the institutional level, multinational investors are adapting to this changing landscape by spreading capital across a wider range of currencies, markets, and asset classes. This behavior reinforces the trend toward diversification and reduces the concentration of financial power. As more capital flows into emerging markets and non traditional financial hubs, these regions gain increased access to investment and technological resources, further strengthening their economic position. The gradual nature of this transition often masks its significance. There is no single moment when dominance abruptly shifts, but rather a series of incremental adjustments that accumulate over time. Each diversification decision, each new trade settlement agreement, and each alternative payment system contributes to a broader restructuring of the global financial order, redefining how power, influence, and stability are distributed across the international economy. When economic instability emerges at the national or global level, its consequences rarely fall evenly across society. Instead, the burden tends to shift downward, landing most heavily on working families and middle income households. While large financial institutions and wealthy investors often have access to advanced risk management tools, diversified portfolios, and political influence, ordinary people face limited options. They experience economic shocks directly through higher living costs, reduced job security, and declining access to essential public services. One of the most immediate ways this impact is felt is through inflation. When governments rely on heavy borrowing or monetary expansion to manage debt pressures, prices of everyday goods such as food, housing, transportation, and energy often rise faster than wages. For families living paycheck to paycheck, even small increases in prices can disrupt household budgets. Rent becomes harder to afford, grocery bills stretch limited income, and savings lose purchasing power. Inflation acts as a hidden tax, eroding economic stability without the transparency of direct taxation. Higher interest rates create another layer of strain. As governments and central banks respond to inflation or investor concerns by raising rates, borrowing becomes more expensive. This affects mortgages, student loans, credit cards, and small business financing. Young people trying to buy their first homes face higher monthly payments, while small entrepreneurs struggle to secure affordable capital. Meanwhile, large corporations often have access to cheaper financing through global markets, reinforcing economic inequality. Public services also come under pressure when governments devote more revenue to servicing debt. Funds that could support education, healthcare, infrastructure, and social programs are redirected toward interest payments. Schools may face budget cuts, hospitals operate with limited resources, and infrastructure projects are delayed or canceled. These reductions affect community well being and long term economic mobility, particularly in lower income areas that depend heavily on public investment. Job insecurity tends to increase during periods of financial uncertainty. Businesses respond to volatile conditions by slowing hiring, reducing hours, or laying off workers. Temporary contracts and part time positions become more common as companies attempt to remain flexible. Workers lose bargaining power, wages stagnate, and benefits such as health care or retirement contributions are reduced. This instability makes long term planning difficult for families, weakening financial resilience and increasing dependence on debt. At the same time, economic elites often benefit from market volatility through strategic investments, asset appreciation, and favorable policy outcomes. This contrast deepens social frustration and political tension. When people observe that economic hardship is not shared equally, trust in institutions declines. The perception that financial systems protect the powerful while exposing ordinary citizens to risk undermines social cohesion and fuels dissatisfaction with economic leadership. These dynamics reveal that currency instability and fiscal stress are not abstract concepts limited to government reports or financial headlines. They shape everyday life, influence household decisions, and determine access to opportunity, illustrating how macroeconomic shifts translate into personal economic reality for millions of people